Welcome to our CFP exam prep discussion on the capital asset pricing model, commonly known as CAPM. Today we're diving deep into this fundamental concept that frequently appears on the CFP exam and plays a crucial role in investment analysis. Let's break down CAPM into its core components. The model is expressed as expected return equals risk-free rate plus beta times market risk premium. In practical terms, this means we can determine what return an investment should provide based on its systematic risk, measured by beta. Many candidates struggle with understanding beta, so let's clarify this. Beta measures how much an investment moves in relation to the overall market. A beta of 1 means the investment moves exactly with the market. If you're looking at a stock with a beta of 1.5, it means when the market goes up 10%, you can expect this stock to go up about 15%. Similarly, if the market drops 10%, this stock would likely fall 15%. Here's a real-world example that often helps candidates remember this concept. Think of Apple stock, which historically has had a beta around 1.2. If the risk-free rate is 3% and the market risk premium is 6%, using CAPM, we can calculate Apple's expected return as 3% plus 1.2 times 6%, giving us 10.2%. A common mistake on the exam is confusing total risk with systematic risk. CAPM only deals with systematic risk, which is the market risk you can't diversify away. Some candidates mistakenly include company-specific risks in their CAPM calculations, but remember, unsystematic risk isn't part of this model. Another frequent error is misinterpreting negative betas. A negative beta doesn't mean negative returns. It means the investment tends to move in the opposite direction of the market. Gold stocks often have negative betas, which is why they're considered good portfolio diversifiers. When studying for the exam, pay special attention to questions about the security market line, or SML. The SML is a visual representation of CAPM, and the exam often includes questions about whether investments are overvalued or undervalued based on their position relative to the SML. Let's talk about practical application. When you see a CAPM question on the exam, first identify all the components given. You'll typically need the risk-free rate, market return or market risk premium, and beta. Sometimes they'll give you more information than needed to try to confuse you. Focus on these 3 essential components. Here's a memory trick that has helped many candidates. Think free plus 3. Free reminds you of the risk-free rate, and 3 reminds you of the 3 main components of the formula. This simple mnemonic can help you quickly organize your thoughts during the exam. For portfolio managers, CAPM provides a framework for determining if an investment's expected return justifies its risk. On the exam, you might see questions asking whether an investment is fairly priced based on CAPM calculations. If the actual expected return is higher than what CAPM suggests, the investment might be undervalued. Understanding CAPM thoroughly will serve you well beyond just passing the exam. It's a foundational concept in modern portfolio theory and continues to be widely used in investment decision-making. Remember to practice calculating expected returns using different scenarios, and always double-check your understanding of beta interpretation. These small details can make the difference between getting a question right or wrong on exam day.